one would not be faulted for considering the economy to be an ordered organism of its own, responsible for regulating the flow of money around the world. Indeed, an organism needs to shut down or hibernate from time to time to set things in order again. In terms of the economy, this is known as a crash. Now, the words market crash have a connotation of doom to them, and it really is such for many people. For many others, it can be an opportunity. You just have to look at it carefully. Before we unravel how such an event may be an opportunity, make sure to like this video, subscribe to this channel, and click the notification bell for new updates. Done that? Let's get into it. Unlike the stock market, where consumers are aware of and accept the risk that prices will fall from time to time, sometimes dramatically, many people who purchase a home do not believe that the value of their home will ever drop significantly. When compared to other asset types, the housing sector has typically been stable. This could be due to the high transaction costs of buying a home, as well as the ongoing expenditures of owning and maintaining a home, all of which discourage speculative activity. However, property markets do occasionally experience moments of irrational exuberance, with prices rising rapidly before returning to normal. Sometimes the popping of a housing bubble can indeed have unintended consequences across the wider economy. Housing prices, like the prices of any other item or service in a free market, are determined by supply and demand. Prices rise as demand rises and supply lowers. In the absence of a natural calamity that would restrict the immediate supply of housing, prices rise when demand tends to outstrip supply trends. Because it takes a long time to build or fix up a house, and because there isn't any more land to build on in heavily populated areas, the housing supply can be slow to respond to increases in demand. As a result, if demand increases suddenly or for an extended period of time, prices will almost certainly rise. When excessive risk-taking becomes prevalent throughout the housing market and prices no longer reflect anything near to fundamentals, the bubble finally bursts. This will occur while the housing supply continues to rise in response to the previous demand surge. To put it another way, demand falls while supply rises, resulting in a significant drop in prices since no one wants to pay for even more homes at even greater prices. Losses sustained by homeowners, mortgage lenders, mortgage investors, and property investors have caused this understanding of risk throughout the system. The United States' economy witnessed a broad housing bubble in the mid-2000s, which aided in the onset of the Great Recession. The Great Recession was characterized by a dramatic drop in economic activity in the late 2000s. It's often regarded as the worst downturn since the Great Depression. When the housing market in the United States transitioned from boom to bust, large sums of mortgage-backed securities, or MBSs, and derivatives lost significant value, which then led to the economic depression. Following the dot-com bubble, real estate values began to climb, encouraging speculative purchasers, speculators, and other consumers to become homeowners. However, many speculative investors stopped buying when the danger became too great, causing other buyers to exit the market. Indeed, when the economy tanked, a large number of subprime borrowers found themselves unable to make their monthly mortgage payments. As a result, prices began to fall. Massive amounts of mortgage-backed securities were sold off, as mortgage defaults and foreclosures reached new highs. Of course, the Great Recession that was the result of the housing market crisis was a sordid affair, no one can deny that. A few astute and smart investors, however, profited immensely. How? To begin understanding that, let's first understand how crises affect investors. Traditional financial theory predicts that investors will act rationally in order to maximize utility. However, this is not always the case. People, on the other hand, frequently act impulsively and allow emotions to get in the way, especially when the economy is in disarray. Behavioral finance is a new topic that aims to describe how individuals actually behave rather than how financial theory says they should. Consider the case of a blackjack player in a casino. When he's winning, he may begin to play more cautiously and place lesser bets in order to protect his earnings. However, if the same player is losing money, He may increase his risk by doubling down or raising bets on riskier hands in an attempt to break even. Investors behave in a similar manner. Unfortunately, taking on too much risk when you're losing money just serves to increase the size of your losses. While most investors are panicking as asset values fall, others who keep their cool can perceive the low prices as a purchasing opportunity. Purchasing assets from restless persons who are driven by dread are similar to purchasing them on sale. Fear frequently drives asset prices substantially below their intrinsic or fundamental values, rewarding patient investors who wait for prices to return to expected levels. Investing in a crisis demands patience, discipline, and of course, a sufficient amount of liquid assets to make opportunistic purchases. When disaster strikes, markets anticipate the worst and punish equities accordingly. When the dust settles, however, optimism returns and prices revert to their previous levels, with markets responding to fundamental signals rather than perceived turbulence. From the German invasion of France in World War II to terrorist assaults like those on 9/11, the Ned Davis Research Group looked at 28 worldwide crises throughout the last century. Markets overreacted and plunged too far each time, only to rebound quickly. Those who sold on fear had to buy back their portfolios at greater prices, while those who waited were rewarded. Following the Great Recession, stocks are currently in the midst of a 6-year bull market. Those who didn't panic saw their portfolio values return and even increase, while those who decided or were forced to sell and waited until the bull market was fully underway to re-enter are still licking their wounds. In a crisis, stock markets aren't the only avenue to invest. As the housing market bubble burst during the Great Depression, property prices plummeted. Many properties were underwater, with the mortgage amount owing to the bank exceeding the equity worth of the property, as a result of people who could no longer afford their mortgages. As the housing market has steadied and rebounded, homebuyers and real estate investors have been able to obtain valuable real assets at below market prices, resulting in handsome returns. Similarly, so-called vulture investors have profited from acquiring good companies that have been harmed by a recession but otherwise have strong fundamentals. There are many things you can do to carefully invest in the housing market to fortify your base. Another strategy to profit from a crisis is to stake a wager that one will occur. One approach to profit from a bear market is to short all equities or equity index futures. A short seller borrows shares they don't own in order to sell them and, presumably, repurchase them at a cheaper price. Option techniques, such as buying puts that grow in value as the market falls, or selling call options that expire at zero if they expire out of the money, are another way to profit from a falling market. In the bond and commodity markets, similar tactics might be used. Short selling is prohibited for many investors, and they do not have access to derivative markets. Even if they do, they may be hesitant to sell short due to an emotional or cognitive bias. Owning a well-diversified portfolio, including positions in asset classes with low correlations, might help cushion the impact for those looking to simply protect themselves from a crisis rather than wager on it happening. Those who have access to derivatives markets might use hedging tactics like a protective put or covered call to mitigate potential losses. Many people are wondering if the real estate market would implode in 2022 after a year of record home price increases, ridiculously low commercial property cap rates, and severe competition in both residential and commercial markets. After all, history tells us that record-breaking growth can't persist indefinitely. Given the present pace of home sales, months of supply is a measure of how long it would take for the existing inventory of homes on the market to sell. There is a 5-month supply of homes for sale if there are 50 properties on the market and 10 homes sell each month. On a national level, according to the most recent census data, there is about a 6.5-month supply of homes, which is considered a balanced market. The National Association of Realtors, NAR, reports that there is a 2.1-month supply, indicating an imbalance and a seller's market. Data from the United States Census Bureau on home starts and building permits for the first half of 2021 shows that house starts are approaching 1.7 million units, According to CBRE Group, 190,000 rental units have been supplied year to date until the third quarter of 2021, showing that the gap between the present supply and the 2020 Freddie Mac estimated shortage of 3.8 million housing units is rapidly closing. Hyper-expansion is the ultimate stage of the real estate market cycle, when building and delivery surpass demand, resulting in a tipping point and a recession. If current levels of building persist, or if other variables, such as increasing property deliveries as a result of homeowners seeking to avoid foreclosure, occur at the same time, home values may decelerate or even reverse in 2022 or just beyond. While there are a number of reasons that might drive real estate over the edge in 2022 or beyond, none of them are likely to result in a market crash as we've seen in the past. Real estate market crashes aren't as typical as many people believe. Apart from the Great Recession, real estate values surged throughout the dot-com bubble and recession of 1990 to 1991. A significant economic event, such as new fiscal policies, a stock market crash, or uncontrolled inflation rates, might undoubtedly result in a real estate market crash. But there is no assurance that this will happen. Only time will tell what the future holds for the market. Investors and homeowners should not be concerned about market timing. If it happens, it's a fantastic time to buy real estate at a lower price than today's prices. That's all for today, our dear viewers. Let us know what you think of a housing market crash in the immediate future, and what opportunities may arise. As always, thanks for watching, and remember to like this video, subscribe to our channel, and click the notification bell for new updates.